So thank you very much to all the panelists for all the sessions that we have been having today. And right now, indeed, we are able to proceed with a small little intervention from our experts from the US. So Manmohan Singh from EMF will be able to address you here today. This will be really a small intervention, and he will be able to take some questions from you in the room. But after his intervention, please do stay here in the room so that we're able also to take a family photo of all of us at the conference. So please stay here after his intervention. Manmohan, welcome. Can you hear us? So I'm leaving the floor to you then to intervene. Welcome.
Balance sheet. It's very difficult for the dealer banks to get more transactions. They pick and choose. Prime brokerage is preferred to repo, etc., etc. Competing with central bank balance sheet, I can show you that the plumbing, the global plumbing, is being very bifurcated, and you do not get uniform signals. We need to reduce the reliance on the older pipes, but there is a desire to stay on the legacy side. It's not easy to bring on DLT. We heard some of the pros and cons in the previous slide. Central bank footprint is very large, so unless new pipes come, it will be very difficult for central banks to leave the footprint. Now, slide. Most of you know this work. I keep looking at this every year. JP Morgan remains the biggest pipe here in the US. There are others, but nobody comes close to JP Morgan and Goldman Sachs. Merrill is still there. Citi is still there. But on the European side, this is happening in Prague. So on the European side, Barclays has stood out. It keeps growing. You have some new entrants, HSBC, Nomura, RBC, Toronto Dominion. But these pipes cannot do more. If you see some of the numbers, many of you may be familiar, the collateral velocity or a wave when this cash and securities meet in the market plumbing is stuck, is nowhere moving up. This is the dealer balance sheet constraint, and moreover recently, central bank competition. Central bank balance sheets are doing the plumbing. Money doesn't have to go through the plumbing to earn a rate of return. These numbers, for those who are familiar, are not moving at all for the last 5 years. This used to be the plumbing before Lehman. You go, money would come from money market funds, from the asset managers. Hedge funds would bring in the securities, and dealer banks were the liaison. And you get your repo rates, you get your prime brokerage rate, you get a sec lending rate, you get derivative margins. That's pre-Lehman. Fast forward, this is the new plumbing. Central banks are huge. RRP has trillions, the reverse repo program at the Fed. Excess reserves also, the money, the QE and COVID money, in trillions. Now this money, if it has a direct pipe with the central bank, it doesn't go through the plumbing. It just goes directly. So that money goes missing, and that money could in effect be a signal for a repo or a sec lending transaction. So unless these pipes are reduced, which is very unlikely, the dealer balance sheets can only do so much. In other words, we have not created new pipes. We have got pipes now to central banks. Either those pipes should reduce so we get cleaner market signals, and if they don't, then the central bank remain there, and some of the DLT, etc., can wait because central bank footprint remains there. Pipes and rules are not easy to twist around. Now, a couple of years ago, there was a lot of talk about FICC, CME type of netting. It didn't work out. Now there is discussion about all-to-all trading. It's not easy. Off the runs are not easy to trade. We saw that in September 2019. We saw that in March 2020. In the euro area, we know specials are hard to find, and if they come, dealers face counterparty limits. Sometimes it leads to fails. So there are issues out there, but rules and regulations don't change overnight. Transmission is also weak. Most banks pay very little out here. Even if the rates are over 5%, most people out here in deposits are getting 20, 30, 40, 50 bips in their deposit accounts. So velocity of collateral needs to remain high, whether we do it or central banks come in and bifurcate the plumbing. There are some good moves. I think the next speaker will talk about North, South, Connect, etc. DCC. I think it's a huge plus. There will be new pipes. There could be small bilateral pipes. There may be new securities coming. But this is the future I see. Technology can be a part as long as it's in the reg perimeter. I think some of the discussions mentioned that, but a lot of it is outside reg perimeter. Stable coins are outside the regulatory perimeter, and central banks will not leave the monopoly. So they somehow need to come inside. The pipes need to be inside the reg perimeter. So, I keep reiterating most of the time that the plumbing is bifurcated, large central bank footprint. We do need a rewiring, and I believe in technology, but how it's done, how is rewired, how we can adapt to T0 settlement, which will be gross, will be very intriguing. It's not going to be easy. We have seen a lot of cases where fintechs are there, but not inside the reg perimeter. Alternately, I also see movements in the private sector, that is intraday collateral moves. JPM, Goldman had some transactions, but they may be off balance sheet. So there is a world evolving off balance sheet, outside reg perimeter. There's a large central bank footprint, but these are the plumbing issues. The pipes are full, and at least the old pipes are full, and we either need to reduce the central bank footprint through technology, or the status quo remains, because central banks are also not easy to let go the monopoly on the money side, which is where the technology is coming in. Happy to take a question or two because I know you are probably heading for your lunch. Thank you for the time.